Today we will talk about a topic that is certainly of interest to anyone who wants to effectively increase their savings. The best strategies for investing. Many of us know that simply saving money in a savings account or keeping it under the mattress is not the best choice. So where and how should you place your funds so that they work for you and make a profit? What investment strategies do professionals use and how can you apply them to your goals? Let's figure it out together right after the commercial break. All the time you think where and how to make money, I have an answer for you. Paved is the best platform for investment and earnings. And also, as a bonus, I offer you a promo code for $1,000 upon registration. Link in the description. Chapter 1 Introduction to Investment. Let's start with the most basic. What is investment? Investments are the process of placing your funds in assets with the aim of making a profit in the future. It is like a subfamily that you plant today, hoping that it will bear fruit for you tomorrow. Now there are a huge number of different types of assets in which you can invest. Shares. By buying shares, you become a co-owner of the company and get the opportunity to receive a share of the company's profits in the form of dividends. Bonds are essentially debt obligations. When you buy a bond, you are essentially lending to the issuer of the bonds in exchange for regular interest payments. Currency. Investing in a currency is based on fluctuations in the exchange rate of one currency against another. Real estate is an investment in land, buildings and other real estate with the aim of increasing its value, or earn income from its use. General funds and ETFs are investments in a portfolio of various assets, which allows you to diversify risks. Commodity assets, such as gold, oil, grain, which depend on the global economy and political environment. These are just some of the types of assets that you can invest in. They all work differently and offer different levels of risk and return. It's important to understand how each asset works before you start investing. Chapter 2 Understanding Risk and Return. An ideal investment asset that is both risk-free and highly profitable simply does not exist. You always have to balance between risk and return. Risk refers to the probability of loss, while return refers to the expected return on an investment. Risky investments often promise higher returns than safer strategies. For example, stocks have potentially high returns, but they can also be very volatile, which increases the risk of losing money. On the other hand, safer assets such as government bonds or bank deposits usually offer lower returns in exchange for less risk. Therefore, when deciding what to invest in, it is important to take into account your personal degree of risk tolerance. If you are not willing to risk a significant portion of your funds, you may be better off sticking to safer assets, despite potentially lower returns. If you are willing to accept a higher level of risk in exchange for a potentially higher return, stocks or other risky assets may suit you. However, it is important to remember that in order to reduce the overall risk of losses, it is important to diversify the investment portfolio, i.e., allocate investments among different assets. Chapter 3 The Importance of Diversification. Diversification is an investment strategy in which funds are distributed among different types of assets, in order to reduce the risk of losing investments in the event of an unfavorable change in market condition. For example, if you invested all your money in the shares of one company, then if the news for this company is bad, or negative market trends, the stock may drop in value and you may lose a significant part or even all of your investment. However, if you have invested in more than one company but spread your funds, for example, between stocks of various companies in various sectors of the economy, bonds and, say, real estate, then the risk of losses is reduced. A drop in the stock price of one company or one industry can be offset by an increase in the stock of other companies, or income from bonds and real estate. That is why diversification is considered one of the key strategies to reduce risk when investing. Chapter 4 How to Choose the Right Assets. The choice of assets for investment should be based on several key factors, including your investment goals, your personal risk tolerance and your investment horizon. Investment goals. This is what you hope to achieve with your investment. Maybe these are long-term goals, how to save money for retirement, or short-term goals, how to pay for a child's education. By setting clear goals, you can select the assets that will help you achieve them. Risk tolerance is your ability to take losses. If you are in a position where you cannot afford significant losses, you should stick to safer assets such as bonds or deposits. However, if you have the ability to take more risk, you might want to try riskier assets such as stocks. The investment horizon is the period of time during which you are going to hold the investment. If you have a long-term horizon, you are more likely to see positive momentum in a volatile equity market. In contrast, Someone with a short investment horizon may have less time to recover from a market downturn. Of course, these are just general principles. Investing always comes with a risk of loss, and it is always advisable to consult a specialist before investing significant amounts of money. Chapter 5: Long-term investment strategies. Long-term investments are often linked to large, important financial goals such as retirement. When planning for such a long period, certain types of investments may be more attractive. Investment funds for pensions. Many countries offer tax incentives for investments in pension funds. These investments are usually managed by professionals and offer the opportunity to diversify into stocks, bonds, and other assets. Bonds are debt securities issued by companies or the government. Their main attraction is that they provide a stable income in the form of coupon payments. Their value is less volatile compared to stocks. As a long-term investment, stocks can offer high returns, but they also carry more risk. Equity investments should be carefully chosen and are best complemented by other more stable assets. Investing in real estate. Investing in real estate can provide a steady income in the form of rent and potential increase in property value. Index funds or ETFs. These investments track a specific index such as the S&P 500. They allow an investor to invest in many companies at once, which is called diversification. Remember that long-term investments require patience and making decisions that best suit your financial goals and risks. Chapter 6: Short-term investment strategies. Investing can be a great way to achieve financial goals. Choosing the right type of investment depends on the specific goals of the investor. As a general rule, investments with low risk and fast expiration are most suitable for short-term goals. Deposit accounts. This is one of the easiest types of investments. A bank deposit or savings account usually offers a fixed interest income and is protected from losses. Short-term bonds. Short-term bonds can offer slightly higher returns than deposit accounts and are relatively safe. Money market funds. This is a type of mutual investment fund that invests in short-term debt such as treasury bonds and corporate commercial paper. They offer high liquidity and low risk. Bills of exchange. These are short-term bonds issued by companies or the government. Notes are usually low risk and can be redeemed before they expire. ETFs and fixed income funds. Exchange-traded funds, ETFs, and fixed income funds can offer investors access to broad, low-cost markets. And while some may carry a high level of risk, others tend to be low risk, and may be suitable for investors seeking short-term investments. It is important to remember that when choosing an investment vehicle, you should always consider your financial goals, timing, and risk appetite. This concludes the first part of our video. In the next part you will learn how to manage an investment portfolio, learn the mistakes to avoid and the secrets of advanced investing, and get step-by-step instructions just for you with your budget and a specific earnings plan. That's all. See you in the next video.